Lesson 9, Central Banks. Main Lecture 1. Introduction. A central bank is a financial institution that controls countries' monetary policy, and usually has several mandates including, but not limited to issuing national currency, maintaining the value of the currency, ensuring financial system stability, controlling credit supply, serving as a last resort lender to other banks and acting as government's banker. The central bank might be or might not be independent, the government. In theory, independent central bank will ensure there is no political influence over the central bank's policy. However, even with the so-called independent central banks that is not always the case. Some of the well-known central banks are the U.S. Federal Reserve, Bank of England, Bank of Canada, Reserve Bank of Australia, and the European Central Bank. Some central banks are responsible for single country monetary policy, for example, the Bank of Canada, while others manage the monetary policy of group of countries like the European Central Bank. There is no single naming convention for central banks naming, but usually the name is in one or close to one of the following forms: Bank of Country, Central Bank of Country, or National Bank of Country. One notable exception here is the U.S. Federal Reserve. 2. Monetary policy. Central banks manage their country's monetary policies, which includes currency issuing. Most world currencies are fiat currencies, not backed by silver or gold, maintaining the country's FOREX and gold reserves, managing money supply, and managing the cost of credit by setting interest rates. The monetary policy enforced by a central bank is used in general to influence the economic activity, avoid recessions, facilitate economy growth, etc., and control inflation. 3. Short-term interest rates. One of the most powerful weapons in central bank's arsenal is the short-term interest rate setting. The short-term interest rate is the overnight interbank lending rate. Lowering the short-term interest rate in effect lowers the cost of credit, thus stimulating people and businesses to borrow and hope to expand the economy. Increasing interest rates makes borrowing more expensive, and is usually used to control overheating economies and inflation. 4. Open market operations. Open market operations are purchases and or sales of government securities in the open market. Central banks use open market operations to effectively control the money supply, the total amount of money circulating in the country's economy. Purchasing government securities expands the money supply, while selling them actually contracts the money supply. 4. Differences between a central bank and a commercial bank. Central bank, commercial bank. The central bank occupies a dominating position as it is the apex bank among all the banks in the country. A commercial bank occupies a subordinate position in the banking structure of a country. There can be only one central bank for the entire economy. There is a large number or network of different commercial banks in a country. It is a non-profit making financial institution. It is a profit-oriented financial institution. The central bank has the monopoly power to issue currency notes from 2 rupees and above. A commercial bank cannot print currency notes. It is owned by the central government. The central bank has the monopoly power to issue currency notes from 2 rupees and above. It can act as clearinghouse. It cannot act as a clearinghouse. All commercial banks and the government are the account holders of this bank. Individuals and institutions are the account holders of these banks. It can provide loans to scheduled banks and financial institutions. It can provide short-term and medium-term loans to the individuals and industries. A central bank itself is a government bank. Only a few commercial banks are nationalized.